Let's talk about this. The average price point in the Denver metro area for a home is, around in the 600s, right? That puts the average mortgage rate above $4,000 for those first-time homebuyer loans, below, 5% down and all of the things. That's true. You don't need 20% down to buy a home, but you may need 20% or more down to have an affordable mortgage, unless we look into other options. We're getting creative today, so stay tuned. What's up, guys? My name is Jeremy Kane. I am with eXp Realty, living in the Denver suburbs over on YouTube, and I would absolutely love to talk to you about all things real estate. So if you are interested in looking at creative options to help you, I totally understand that homes seem a little bit out of reach for some. I want to pull that reach, at least hope back and help be a part of your story to build multi-generational wealth through real estate. And today we're talking about multi-generational living. So while you're here, like, comment, subscribe. I put a ton of content out about helping people get into homes. But let's talk about this. Why are we talking about multi-generational living? Well, it's pretty obvious that if you put more people into a home that have incomes and are working full-time jobs, it can, help with the share of the cost. This is something that is absolutely on the radar, right? Whether it was COVID and people kind of coming together and wanting to be, in the same household with their own, or completely opposite of that, where it's just out of necessity, right? We have a ton of huge homes, especially in the suburbs, where I live and work. And so using that square footage fully is absolutely something that has helped make homes more affordable. So the multi-generational piece of the process is coming in, and it doesn't have to be multi-generational. It could be, group living, with a sibling, or, say you're looking to move two families in together. As long as you have the space, this is something that people are looking to do. I've helped brothers purchase a home together. But also typically when we look to this multi-generational living piece, we're talking about, moving in with another generation. And so all of these things are absolutely on the table and absolutely help when it comes to. So let's talk about that with the benefits. Obviously, you have all your people together. I don't think I've ever met a family that's not like, oh, we should have a homestead and everybody could have their own house. This is a little bit different because you're in one, but bringing all of your people together into one space is oftentimes positive, as long as you like your family members. Next, obviously, the cost, the affordability, having multiple streams of income to help pay for the costs. Everything is expensive these days: the groceries, the utilities, the mortgage, and all of the things. So that's super important as well. Obviously, you have, in my instance with the little ones, if I lived with my family, we'd have built-in childcare. That can't hurt anybody for sure. So all of these things are absolutely benefits. Now let's talk about the risks, right? The risks start to come in when we're talking about the financial pieces of it. A couple risks that come off is what happens when we are trying to separate this, right? And when, we're in this situation, what do we do? We're not talking about tenancy, right? Joint tenants, tenants in common, that's pretty much an upfront way to see how it kind of is deciphered. But what's that look like, right? When a mom or a dad, or a mom and dad, are putting into a home and investing into that with one sibling, and there's some other siblings, what happens in the event of, the mom and dad not being there anymore and the other siblings coming in? That's number one. You got to make sure how that's going to look if there are other, heirs involved, because the last thing you want anybody to go through at that time is the back and forth with the siblings, and I paid for this and they paid for that and whatever. And so that's the first risk. What happens if we have, we want to break it up, right? Somebody wants to move, somebody doesn't want to move. How is that handled? Because now with multiple people on the mortgage, those debts are incorporated and part of what is going on. So that's super important to really get into and understand, and have a plan, right? Whether an attorney's drafting documents, so what happens if this, or whatever that looks like, at least have those conversations, because there's no faster way to break family apart than, having that financial stuff get involved. Now let's talk about the loans, right? And most loans, if people are living in a primary residence, do pretty well. There's a lot of options. The one exception that I talked to a lender today about was if it's a VA loan, it has to be a spouse that's in on it. Once you go to brothers, siblings, moms, dads, things like that, the VA gets a little bit weird. There is a minimum down payment requirement. I'm not a lender. The lender did say that it's 12.5 and subject to the VA approval. So the VA has a little bit of benefit issues with, outside of the spouse and that kind of stuff. So one of the benefits of the loans in general is that you bring more income in to the, equation, but in the event it's not, a spouse's income on that VA could, require some money down in order to use that benefit, in that type of loan. So just make sure you know that up front. But as long as it's a primary residence for everybody on the loan, there is not a lot of red tape there for the mortgage. Well, that's pretty crazy, right? No red tape for the mortgage outside of the norm. So that's good. Now, what happens if somebody wants to move out? They're on the mortgage, say the mortgage interest rate is super low, it's locked in for 30 years. Well, in order to get somebody off of a loan, you have to refinance it, therefore foregoing that lower interest rate. So, in those, specific times, that could be an issue and could ultimately be a disaster where, you have to give that up and you don't want to move and all the things. And so that's super important to make sure that you are aware of and have those conversations up front. And what's that looking like? Because the last thing we want to do is do this for affordability and then someone is stuck on the mortgage, right? They could move out, that's fine. But the person that's left, if, was not the greatest, exit, they still have control of the payments and they're going to pay them and whatever, but the person's credit is still on that and they're responsible, in the event of default as well, just as much as the person that's still living there. Not to mention they can't just go buy another house if their debt to income ratio is out. And that's the next piece, is this debt, right? The debt on the home. And we talked a lot about bringing other people in for more income and all of that. When you bring more people into a mortgage, there's also, you're bringing their debts, right? So the debts play into the debt to income. They take the total income of everybody. They take the total debts of everybody. And then they take the lowest mid credit score from whomever that might be, right? There's a low, a mid, and a high credit score. They take the mid score in a typical mortgage situation. And so if they're taking the lowest mid score, that means that your loan is subject to the terms that are, attached to that setup in that mortgage. So while it seems like it's a really good idea, if everybody's all in, everybody's on the up and up, it could be a really good deal. However, if everybody's not in on that, and some, a parent's coming along and say, hey, I want to help my kiddo, they've had some trouble with credit and all of that. If they're going to need that kiddo's income and the credit comes in with it, that could affect, the par interest rate, right? All these interest rates we talk about, and people throw out that shouldn't and should, that's usually the top-notch qualified 20% down or whatever the best percentage down is. That's usually where that number comes from. So it's not always cherries and rainbows, as I like to say. I work with some very creative lenders that can get you guys into the best situation. Obviously, there's all kinds of options as well of people being on the mortgage and different people being on the deed. Usually the person on the mortgage has to be on the deed, but there is creative options there. That just ups the risk, right? If everyone's not, that's there is not responsible for the mortgage, then risk comes into play. So this is why, the traditional mortgage is pretty set forth with a spouse and another spouse and the income and that kind of stuff. But we are having to get creative in these high interest rates and these high affordability, limits. So I hope this helps you guys. If you have any questions, please let me know. I would love to connect you with a creative lender and discuss a plan. My favorite thing to do is make a plan, whether it's a long-term, short-term, and make it come to fruition. So there's always options for home ownership, and multi-generational living seems to be one of the ones that we're focused on right now. Have a good one.